Fellow traders, tis I, the Rumpled One, coming to you on Tuesday, March the 25th. The year's 2025. Let's talk trading. Expectancy with Walmal. These videos are for educational purposes only. Your results may differ from mine and different from Walmal's. And just so you know, everything's okay. I just didn't make a video yesterday. It was a travel day. It was kind of busy for me. So anyway, expectancy. This is Walmart. I'm going to pass it over to you because this was your idea for the video.
Basically, the whole idea of expectancy is
Hey, you have to
what do
you
you
have to turn
expect?
your mic up. You're a little low
Okay,
again.
all right. The whole idea, expectancy is how much are you winning compared to how much are you losing? What do you expect to go and have at the end of the day? And then there are several different formulas that are floating out there as to how to calculate that. But the one that I like to use is I like to go and take my win percentage and then multiply that by my average win size. And then from that, I subtract my loss percentage times my average loss size. And what you need to have is you need to have obviously a positive number. And using that in that particular case, what most people like to go and see is they like to go and see basically 0.25 or better is what people like to go and see. So let's go and take a real life example. I wish I made a card up for this. We should have, but that's okay. Let's say that you win 60% of your trades and your average win is $200 and you lose 40% of your trades and your average loss is 100. Well, then you take 60%, multiply it by the 200, okay, which will give you 120. From that, you subtract out 40% times $100 or $40. So you would have $120 minus $40. So you would have a expectancy of about $80 per trade. Now, what does that actually mean? That means that if you take a trade, you expect to go and make $80. That doesn't mean that you shoot for $80. You still shoot for $200. But if you shoot for the $200, then you're going to get, you would expect to get $80. So why is that important to us? Well, it's important to us because when you're going and evaluating methodology or some type of strategic methodology, you need to go and lay that out because some methods you can expect to win literally 95% of the time. And other methods are out there you can expect to go and only win maybe 10% of the time. Both of those methods could be winning methods, and both of those methods could be losing methods because you have to consider not just how much you win. I think so many people sit there and they say, I can go and make a lot of money. I know I can make a lot of money on this method because I win 99% of the time. And I can go and absolutely prove to you you can win 99% of the time and still lose money. Because if I'm winning 99% of the time and I'm only making $1 per trade, that's what does that come to? Take that same formula you did before. Take the 90%, 99 times $100. What is that going to give you? That's going to go and give you 199. Is that right? 99 times 100. Sorry about that. I got to get my arithmetic working here. 99% of the time times $1 basically means you're gonna win basically 0.9%. Your 0.9 dollars is what you're gonna get. Whereas let's say you lose only 1% of the time, but you lose $1,000 every time. So you're gonna go and take 0.9 and you're gonna subtract out $900. Okay, $990 to be exact. And so you're going to be down in a hole big time. So just because you win almost every trade doesn't mean you can make money doing this. And you need to go and take that into account. When you write up your trading plan, you need to take into account not just how many times I win, but also how is your the dollars that you're winning compared to the dollars that you're losing. Now I know for a fact that when I do flip flop, I win roughly somewhere around 85% of my trades. and I know that on my average trade, I make about 4.5 pips. That's what it just turns out over long term. That's what it's come out to, about 4.5 pips. Okay, and then the 15% of the time when I lose, I wind up losing about 5 pips. Now, I don't have to do the arithmetic on that. I can go and say, hey, that 4.5 and 5 are so close to each other that I don't have to really write down. But at the same time, it's good to know those numbers. Spend the time putting those numbers together. So does that make sense what I said at
Yeah,
TRL, or
yeah.
did I confuse people?
No, well, basically, with the expectancy, it's like you said, you have to see how much you expect to lose, and just make sure when all's said and done, you, you're not gonna lose overall. You might lose on a particular trade, but it's a series of trades. It's not any one particular trade. It kind of goes back to Mark Douglas trading in the zone. You know, it's like, hey, I expect to win, but this trade, I don't know. I
Okay.
might lose. I might lose the next two, three, four, five trades. But if I stay in for 100 or 500 or 1,000 trades, I'm going to walk away, with more money than I started with.
Right. And that's what it really comes down to. You just gotta go and keep that in mind. And when you're going and testing things out, you know, I say this all the time, and I know Tiro, you say things that are very similar. And that is that I can sit here and trade a particular method, make money on it, and another trader can come along and trade the exact same method and lose money. And so we have to sit down and figure out why is that? Why is it because just emotion? Is it just used to call it the gray matter? What is your brain thinking, right? And it may very well be the only difference between your trading and my trading may be just that I'm holding out just a second or two longer, getting a little tiny bit more in terms of my pips, on my wins, and I'm cutting my losses a second or two earlier, and not taking as big a loss. And that difference of 1, 2, 3 seconds on a trade can make all the difference in the world.
Oh, for
It's sort of like,
sure.
yeah, you just saw me in a trade that I was just in, where I was in the trade, and if I had just waited literally another 4 or 5 seconds, I could have picked up 9 pips. And I had made 9 pips in the trade, but I could have easily picked up another 9 pips on that one particular trade. And all it would have taken was me to sit in the trade literally for another 2, 3, 4 seconds. And so that part of that's luck.
Yeah,
Part of it
well, the
is
thing is, and it's
experience.
it's that's part of the emotion, because what happened was you got in a trade and it ran against you, and then I don't know how many deals were you in that one, three or four, right?
I was in 3 trades,
Yeah,
three
and
deals.
so what happens is, rather than trade the chart, we have a tendency to start trading emotions. In other words,
Right.
it feels bad when you're looking at the screen and you're in the hole. It's
Yeah.
red, you're down, there's a
Right.
big minus sign. It feels good after you see that big red minus sign, that all of a sudden now it's green. It's like, oh, wow, let me get out of this. As opposed to
Right.
saying, look at the chart. What's the chart? Oh, the chart's saying, oh, it's breaking through resistance. There's a return bar it needs to hit. As we were talking, price was going down, and I was moving my cursor to point out there was a lower low wick zone, and price was up around, I think, 51 or something at the
Right.
time, and I was like flagging this, and that was like, hey, here's where price is probably going to go. And what happened? It came right down and hit that lower low wick zone.
Right.
Now the thing is, had I been in a trade, and let's say I had gone short and it ran up against me, 3, 4, 5 pips, and maybe I entered again or maybe not. But it's like, as soon as I see like I can get out for a pip, I was like, I'm out. And then it's like, dang it, if I would have only
Yeah.
waited.
Yeah. And to make it even worse for me was the fact that I was in the trade, and when I first went in trade in the first deal, what happened was I was actually up, 4.9 pips, and I saw where it was going to go, and I need to hold on to this. This thing's going to go all the way up to 60, and what it did was it got to 60. Problem was it went all the way down where I was now 5 pips underwater on it because it ran 10 pips in the other direction, and so that plays in the emotion too. So like I could have had all those pips, and I was greedy. No, I wasn't being greedy. I was trading what was on the chart. And the problem is, the chart doesn't always do what price doesn't always do what the chart says it's going to
I
do. You just
know.
have to be willing to accept that.
Yeah.
And then what happened was, you're right. I got into the trade, took two more trades because I had two more signals to go long. So I executed that very well. But to be honest with you, what happened then was it turned into a numbers game for me. It was no longer about what the chart was saying it was going to do. It was now a question of how many pips am I going to be able to get to so I can break even, and then hopefully pick up just maybe. To be honest with you, I was only looking to pick up 1 or 2 pips at that point in time. I was happy to get out with 1 or 2 pips, and it was emotionally driven, no longer chart driven. Because what happens, and I got lucky because it got to that point and it didn't show any signs of slowing down. So I held on for a little bit longer. At that point, I was able to get my 9 pips. And then at that point, I said, okay, I'm right at the area where it flipped around the last time. I'm not taking a chance again. I'm
Yeah.
getting out right here. And call that smart, call it stupid. I don't know, call it whatever you want to call it. But emotion then jumped in and said, this is where I got burned the last time. I'm not getting burned this time. I'm out.
Yeah. See, like right now, prices turn, and I'm pointing right here to this big down bar. Even though it is only maybe 3 pips, point is that price usually needs to get right back to that level, and that's also looks like it was a gap down. So, and price likes to fill the gaps. Oh, Walmart, there's a trader who wants to know, why do you only trade the pound? Why the
Because I
pound?
know
Yeah.
because I know it.
Yeah, but
It's
there's a
just
little
that
more.
simple.
There's more to it than that.
Well, the WAM was it's what I first started trading. Back in 2006 or 2000, yeah, 2006 is when I first started trading. So I got very, very accustomed to it. And then in time, I did try other pairs, and I found that what was happening was that a lot of times I was having my mindset was being divided. I was looking at this chart, I was looking at that chart, I was looking, and I found that my ability to trade successfully decreased tremendously. In fact, it went down exponentially because I was not having a laser focus on one particular instrument. And, you know, some people can go and, go out there and trade multiple pairs at the same time. I'm not one of them. It's not me. I'm going to trade what I can trade well, and that's it. And I've tried and I got burned on it. So because I got burned on it, I'm just not going to do it.
Yeah.
So that's what it comes down to for me.
Well, also the pound usually has a big enough range, um,
Yeah, yeah. There
and
are reasons.
yeah,
Yeah,
and at the time period that you trade it, there's a lot of volatility or range in that during that time period.
exactly.
And
So
this,
it's
and
a
yeah, and
it's
the
a
spreads, the spread is okay.
right. It's not the best spread. I mean, let's face it, the euro spread is much better than the pound spread is, but it's what you get used to. It's sort of like it's like my sister. She's there. Never gonna go, never gonna go and kiss her, but at the same time, I'm gonna go and have a good time with her.
Yeah. Well, guess what? The fastest 15 minutes trading is just about over. So, fellow traders, expectancy, you know, take some time, look and pull up those charts and see what your expectancy is, um, and let us know if you want to tell us. And if you have any more questions, feel free to ask, and we will answer if we can. And always remember and never forget, it's not what you trade, it's how you trade it. So go out there and drain the banks. This is the Rumpled One, over and out.